Principles of Accounting 2, Chapter 9. In Chapter 9, we continue our budget process and we move on to looking at our budgeted results versus our actual results. So this is called a variance analysis. What we do when we look at the variance analysis is we prepare a report that tells us how our actual results were different from our budgeted results. We then analyze those and try to figure out what caused them. And once we've identified what issues could have caused them, then we're going to look for ways to solve those issues. And hopefully, every cycle when we do this, we're going to get better and better at what we do. Sometimes the things that cause our budget to be different, our actual results to be different than our budget, are things that we can't control. And some things times they are things that we can control. And so we want to look at what it is and then identify whether we can control it or not. Things that are outside of our control are examples like a world pandemic or a natural disaster or a large storm thus causing delays and issues. These things also cause prices to rise, and we might have a price variance in our raw materials just because there was some kind of a natural disaster or pandemic or something that was outside of our business's control. We use what's called a flexible budget. So our planning budget is planned for a very specific level of activity. So if you'll remember the budgets that we did in Chapter 8, that we're going to sell so many units per month or per quarter, and we prepared our budgets according to that information. When our actual activity is different than our planned budget activity, it's difficult to compare the two. So what happens is we create what's called a flexible budget. And a flexible budget is what should have happened at our actual activity. If that sounds confusing, we'll get to how we do the flexible budget. So we prepare for any activity within our relevant range. We show the costs that would have been occurred at the actual level of activity. So if we said we were going to sell 10,000 and we made our budget for 10,000 units, a flexible budget would look at 9,000 units, 8,000 units, 7,000 units, 11,000 units, 12,000 units. This helps us do an actual performance evaluation plan. We're going to look at a lawn service company. So we have a lawn service company. He works in a community where all lawns are approximately the same size. In May, he makes his June budget based on mowing 500 lawns. He feels the number of lawns mowed in a month would be the best way to measure his activity because all the lawns are similar size. So he makes a planning budget. As you can see here, a planning budget is also sometimes called a static budget. Static because it's non-moving. So we have our planning budget on one side and our actual results on the other. So we planned to mow 500 lawns, and we based our budget on our charges and our costs. So we charge $75 a lawn. We have wages of a fixed wage of $5,000 plus a variable $30 per lawn. We have variable expenses of gas and equipment maintenance, and then we have fixed cost for our shop utilities and rent, depreciation, and insurance. Then on the other side, we see our actual results. Well, our actual results, we actually did 550 lawns instead of our 500 lawns. So when we compare the two on the next slide, we look at our differences. And those are variances. That's our variance analysis. So this is the first level of variance analysis. It's sometimes called the static budget variance. And what the static budget variance is what is just the variance between our actual results and our planning budget, or our static budget. And we can see that we made more. So this F and the U stand for favorable or unfavorable. Favorable means we made more than we planned or spent less than we planned. Unfavorable means we made less or cost more. So we can see that we spent more on wages and salaries, gas, and insurance than we planned, but we made more in revenue and we saved money on maintenance and utilities. Overall, we made more operating income. So we see here a favorable variance when actual revenue is greater than budgeted revenue, or when actual costs are less than budgeted costs. An unfavorable variance is when actual costs are greater than budgeted costs, or actual revenue is less than budgeted revenue. When we see unvariable costs, what we might think is we did a poor job at controlling costs. When we see favorable costs, we might automatically assume that that means we were doing a really great job. That's not always the question that we want to ask. And we can't currently answer this question because our actual level of activity is greater than our planned activity. So our variable costs are already going to be higher than our planned costs, regardless of how well we manage our costs. So in order to really see what our planned budget was, we need to flex the budget. So our planned budget was for 500 units or 500 lawns. Our actual was for 550 lawns. So to flex our planning budget, we would prepare a new budget or a flexible budget of what would our budget had been if we had written it for 550 lawns in the first place. So when we flex a budget, we want to know the total variable costs. So remember, we need to know that cost behavior. So we're bringing back in chapters 1, 2, and 3 here, where we're talking about variable costs and fixed costs being linear within that relevant range. And so our variable costs change in direct proportion to changes in activity, where our total fixed costs remain unchanged within that relevant range. So using our cost equations, we build a flexible budget. So with a flexible budget for 550 lawns, we should have had this revenue and expenses. Now we can compare that against our actual results and see what that variance is. So we're looking at an activity variance. That's that static budget variance, because it's solely due to the difference in the actual level of activity and the level of activity included in the planning budget. When we create a flexible budget, then we get different variances. So we have our flexible budget and our planning budget. These variances, so we can see the revenue variance and the cost variances, this is strictly because of those 50 extra lawns. So the level of activity, because the flexible budget has 50 more lawns in it, it has different numbers in it. So we see activity and revenue increase by 10%, but our operating income increases by more than 10% because of those fixed costs. Our fixed costs weren't any different in our planning budget versus our flexible budget. We have a revenue variance, which is the difference between the actual revenue and the flexible budget variance. And then we have a spending variance, which is the difference between the actual and the flexible costs. So when we look at this, we have our actual results to our flexible budget. We have a $1,750 favorable revenue variance. Then we're going to look at our spending variances. So in our spending variances, that is all of our costs. So we have unfavorable costs, and we can see that we actually had a lower operating income than we would have planned if we had planned for a flexible budget or for a planned budget of 550 units. So now we can look at our costs were higher than our flexible budget. So we paid $2,000 more for wages and salaries than we should have, or our budgeted amounts. We paid more for gas and supplies, but we saved money on maintenance and shop utilities, and we paid more on insurance. Next, we look at a performance report. So this is a full flexible budget performance report. We have our revenue cost formula and cost formulas. So our linear formulas, quantity being the number of lawns that we do, our actual results, our revenue and spending variances, our flexible budget, our activity variances, and our planning budget. And we can see the differences between those two things. The difference between the planning budget and the flexible budget is strictly caused by those 50 extra lawns. The difference between the flexible and the actual are spending and revenue differences. So those are differences in the actual amounts that happened as compared to our revenue and cost formulas. We then look at our cost formulas. So in those activity variances, that amount is 50 lawns times $75 per lawn. And in our cost, that's 50 lawns times $30 per lawn. When we look at this actual minus the flexible budget, then we try to explain, so why was there that variance? We made more than $75 a lawn. We have a favorable variance. At $75 a lawn, we would have brought in revenue of $41,250. We actually brought in $43,000. So when we divide that by 550 lawns, our actual sales price is closer to $78 than our $75 budget. We can also use these performance reports in all different kinds of businesses. So we looked at a service business. We can use these reports also in manufacturing businesses, and we're going to look more at manufacturing variances in Chapter 10. But we can also use those for nonprofits. So nonprofit organizations receive funding from many different sources other than the sale of goods and services. So some revenues could be both fixed and variable elements. So for example, they show universities here. So many universities receive some type of state funding. They receive tuition and fees from students. They receive donations from alumni. They can also receive endowments. Endowments are gifts that have a fixed amount, and the universities can only spend the interest earned on them. The actual endowment can never be spent. That's a whole nother accounting class. We can also use performance reports for different divisions and centers. So when we look at a segment analysis, we could do a performance report for an individual segment analysis. Or a cost center is a center that costs money and doesn't generate revenue. So examples of cost centers within a business are like the human resource department or the accounting department. They don't sell things outside, but they cost the business money. We can also have more than one cost driver. So we might be using activity-based costing. Our cost formulas can have more than one cost driver, as we know. So we're going to look at an example as if Larry's Lawns has more than one driver. So we have that he's decided to add an additional cost driver for the time required for edging and trimming. So even though the lawns are different sizes, they have different requirements for edging and trimming. Sidewalks, different landscaping, etc. So he's going to add a cost driver for the number of hours and look at the number of hours. So now we have both number of lawns and number of hours. And we've split out the number of lawns and the number of hours, and we've added to our revenue and cost formulas. The number of hours and the quantity of lawns are both variable costs. Our fixed costs remain the same. So we've created a new planning budget and a new flexible budget using this information. Now when we compare to our actual results with our performance report, we can see that we had an unfavorable revenue, mostly unfavorable revenue and spending variances. So, but knowing that taking that extra time with trimming and edging and adopting these new cost formulas can help Larry plan a better budget for next month and plan better cost estimates and revenue estimates for his customers. So he knows that customers that take extra time need to be charged more. That's what he's figured out, that he can't just charge a flat $75 fee for lawns that have extra trimming. Of course, in class, we will prepare this flexible budget and we will prepare variances. These are called level 1 variances, and we'll be looking at the other variances in future chapters, in chapters 10 and 11.